If you've been watching your portfolio take a hit these past few months, you're not alone. The stock market in 2026 has been a wake-up call for investors who were heavily concentrated in tech, AI, and high-growth names. The era of easy gains in the Magnificent Seven seems to be fading, at least for now, and a powerful rotation is already underway. One that's quietly rewarding investors who are positioned in value and defensive ETFs and stocks. This shift isn't random. It's being driven by a cocktail of macro pressures that aren't going away anytime soon. A softening labor market, sticky inflation risks, geopolitical tensions, reduced expectations for rate cuts, and growing concerns over massive AI capital expenditures are all forcing investors to rethink their risk exposure. Smart money is moving toward companies with lower valuations, stronger cash flows, and greater resilience as the markets get ugly. And that's exactly what value and defensive ETFs deliver. In this video, I'm breaking down the 5 best value and defensive ETFs for 2026, funds that are built to weather uncertainty, protect your portfolio from market downside, and give you meaningful upside when the market stabilizes. In addition, I will show you how each of these exceptional ETFs can generate over $1 million in portfolio value and provide generous monthly dividend income. Whether you're looking to rebalance an overweight tech portfolio or simply want steadier, more predictable returns, these ETFs deserve a serious look. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. The first ETF on our list is the Vanguard Value ETF, ticker symbol VTV. This exceptional ETF is one of the most well-established value funds you can find. VTV tracks the CRSP US Large Cap Value Index, which draws from the top 85% of the US stock market and selects companies using a rigorous value scoring model. That model evaluates stocks using key metrics such as price to book, price to earnings, forward PE, dividend yield, and price to sales ratio, essentially filtering for companies that are fundamentally strong yet trading at attractive prices. The index is also reconstituted and rebalanced every quarter, so the fund stays current and disciplined in its approach. When you look inside the portfolio, VTV holds 312 stocks, with top positions in household names like Berkshire Hathaway, JP Morgan, ExxonMobil, Johnson & Johnson, and Walmart, together making up just over 20% of the fund. The heaviest sector exposures are financials, industrials, and healthcare, and as you'll notice, tech exposure is minimal. In today's environment, that's actually a feature, not a flaw. On fees, VTV is incredibly cost-efficient with an expense ratio of just 0.03%, which translates to only $3 per year for every $10,000 invested. You also get a dividend yield of around 2% paid out quarterly, which adds a nice income stream on top of your returns. And speaking of returns, VTV has delivered 5-year annualized returns of 13.5% and 10-year annualized returns of just over 13%, numbers that are genuinely hard to argue with. With over 20 years of history, a proven track record, low costs, steady dividends, and lower volatility than the broader market, VTV is a compelling core holding for anyone looking to reduce risk without sacrificing solid long-term performance. Well, it's time to check out the numbers. But first, let me break down the formula. Trust me, this is very simple. In most cases, they make it look so difficult that it confuses new investors. But it's not. I will be using the unique future value formula that combines 2 powerful components of wealth building. The first is the growth of an initial lump sum, and the second is the growth of consistent contributions over time, both compounding at an annual rate of return. The formula calculates the total portfolio value by compounding the growth of the initial investment and all recurring contributions, which is why long-term investors see exponential growth in their portfolios over time. With that out of the way, let's dive into the projection of VTV. The projection will be based on Bobby's initial investment of $10,000 and his continuous contribution of $10 per day, totaling $3,650 per year, using the historical blended annual return of 13% and a dividend yield of 2%. At the 10-year mark, Bobby's initial $10,000 grows to $33,900, while his daily contributions compound to $67,087, bringing the total portfolio value to $100,987, which generates approximately $2,020 per year in dividend income. Yes, it does not sound life-changing yet, but that's because time is the fuel behind compounding. Let's check out the next milestone. At the 20-year mark, Bobby's initial $10,000 would yield $115,200, while his daily contributions would grow to $295,358, resulting in a total portfolio value of $410,558 and annual dividend income of about $8,211. Now that's fantastic, but let's check out what can happen at the next milestone if Bobby keeps his money invested. At the 30-year mark, his initial $10,000 would yield $390,000, and his continuous contribution of $10 per day would have grown to $1,067,895, for a total portfolio value of $1,457,895, and annual dividend income of approximately $29,158. Now this is the true demonstration of the power of compounding. I know this is fascinating, but there are even better options, so stay tuned. Next up is the Schwab US Large Cap Value ETF, ticker symbol SCHV. If VTV caught your attention, this one is absolutely worth a close look as well. SCHV tracks the Dow Jones US Large Cap Value Total Stock Market Index, and what makes this fund stand out is how thoroughly it evaluates value. Rather than relying on just a handful of metrics, this index uses 6 different measures to identify true value stocks, covering projected price to earnings and projected earnings growth, current price to book and dividend yield, and historical revenue and earnings growth. You may notice some overlap with VTV in the top holdings, but SCHV gives you over 200 additional stocks, making it the more diversified option of the two, and in uncertain markets, that added breadth can be a real advantage. On cost, SCHV is one of the cheapest funds you'll find anywhere, with an expense ratio of just 0.04%, costing only $4 per year on a $10,000 investment. The dividend yield comes in at nearly 2%, paid quarterly, adding consistent income on top of solid capital appreciation. Performance-wise, SCHV has delivered 5-year annualized returns of 11 to 12% and 10-year annualized returns of around 12%. Steady, reliable, and hard to overlook. Now, let's dive into the numbers of this exceptional ETF. The projection will be based on Bobby's initial investment of $10,000 and his continuous contribution of $10 per day, totaling $3,650 per year. Using the historical 12% annual return and a 2% dividend yield. At the 10-year mark, Bobby's initial $10,000 will grow to $31,100, while his daily contributions accumulate to $64,167, bringing the total portfolio value to $95,267, which will start generating approximately $1,905 per year in dividend income. Yes, it does not sound life-changing yet, but let's check out year 20. At the 20-year mark, Bobby's initial $10,000 would yield $96,500, while his daily contributions would grow to $263,092, resulting in a total portfolio value of $359,592 and annual dividend income of about $7,192. Now that's fantastic, but let's check out what can happen at the next milestone if Bobby keeps his money invested. At the 30-year mark, his initial $10,000 would yield $299,600, and his continuous contribution of $10 per day would have grown to $880,855 for a total portfolio value of $1,180,455 and an annual dividend income of approximately $23,609. Again, This demonstrates the power of compounding. Now, this is fascinating, but there are even better options. So, stick with me. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. The third fund on our list is the Vanguard Mega Cap Value ETF, ticker symbol MGV. This unique ETF brings a slightly different and intriguing angle to the value conversation. While VTV and SCHV cast a wide net across large-cap value stocks, MGV zeroes in exclusively on the biggest of the big mega-cap companies that represent the very top tier of the US stock market. Think of it this way: if VTV and SCHV are the full value universe, MGV is the most elite slice of that universe. It tracks the CRSP US Mega Cap Value Index, using the same rigorous value scoring model as VTV, evaluating stocks on price to book, price to earnings, forward PE, dividend yield, and price to sales, but applying it only to the largest companies in America. Like VTV, the index is reconstituted and rebalanced every quarter to remain disciplined and current. With 123 holdings, MGV is more concentrated than the previous two funds, and that's by design. Top positions include JP Morgan Chase, Berkshire Hathaway, ExxonMobil, Micron Technology, and Costco, which together make up about 25% of the portfolio. Sector exposure is led by financials, followed by healthcare, industrials, consumer staples, and technology, a powerful mix of defensive and economically resilient industries. Now here's where MGV really gets interesting: the returns. Over the past 5 years, MGV has delivered annualized returns of around 14%, and over the last decade, returns of over 13% annually. That concentration in mega-cap names has actually worked in investors' favor, delivering stronger performance than broader large-cap value funds. The expense ratio is just 0.05%, costing only $5 per year on $10,000 invested, and the dividend yield sits at nearly 2% paid quarterly. Now, let's dive into the projection of MGV. The projection will be based on Bobby's initial investment of $10,000 and his continuous contribution of $10 per day, totaling $3,650 per year, using the historical blended annual return of 13.5% and a dividend yield of 1.97%. At the 10-year mark, Bobby's initial $10,000 grows to $35,600, while his daily contributions compound to $69,204, bringing the total portfolio value to $104,804, which generates approximately $2,065 per year in dividend income. Next, let's check out the year 20 milestone. At the 20-year mark, Bobby's initial $10,000 would yield $126,800, while his daily contributions would grow to $315,798, resulting in a total portfolio value of $442,598 and an annual dividend income of about $8,715. Now, let's check out what can happen at the next milestone if Bobby keeps his money invested. At the 30-year mark, his initial $10,000 would yield $452,000, and his continuous contribution of $10 per day would have grown to $1,194,010 for a total portfolio value of $1,646,010 and an annual dividend income of approximately $32,436. Now this shows why great investors like Warren Buffett have consistently emphasized that time in the market beats timing the market. I know MGV is exceptional, but you do not want to miss the next two ETFs. So let's keep going. The next ETF is genuinely exciting for investors seeking greater growth potential in their value portfolio, because that's what the Avantis US Small Cap Value ETF, ticker symbol AVUV, brings to the table. And it all starts with how it's being managed. Unlike every other fund on this list, AVUV is actively managed, meaning a team of experienced portfolio managers constantly evaluates the market and makes strategic decisions to identify small-cap companies with low valuations and strong profitability. That combination of value and quality is a powerful one. With around 775 holdings, AVUV is impressively diversified for an active fund, and no single stock dominates. The top holdings, which include Viasat, Five Below, SM Energy, Matson, and Macy's, account for less than 10% of the portfolio. Sector exposure is led by financials, followed by consumer discretionary, energy, and industrials, a mix that offers real economic breadth. Now, small-cap stocks do carry more volatility than large caps, and that's a trade-off worth acknowledging. But that added risk comes with a compelling reward: greater growth potential, especially given that small-cap valuations are still significantly more attractive than stretched large-cap valuations right now. The performance numbers back this up convincingly. AVUV has delivered annualized returns of around 12.7% over the past 5 years, and over 15% annually since its inception in September 2019, meaningfully outperforming the Russell 2000 Value Index. The expense ratio is 0.25%, or $25 per $10,000 invested, which is reasonable for an actively managed fund, and the dividend yield of 1.4% is paid quarterly. If rate cuts resume and macro conditions stabilize, AVUV is positioned to reward patient investors handsomely. Now, let's dive into the projection of AVUV. The projection will still be based on Bobby's initial investment of $10,000 and his continuous contribution of $10 per day, totaling $3,650 per year. Using the historical blended annual return of 14% and a dividend yield of 1.4%. At the 10-year mark, Bobby's initial $10,000 grows to $37,100, while his daily contributions compound to $70,664, bringing the total portfolio value to $107,764, which generates approximately $1,508 per year in dividend income. Again, this may not sound life-changing yet, but that's because compounding needs time to demonstrate its magic. Check this out. At the 20-year mark, Bobby's initial $10,000 would yield $137,400, while his daily contributions would grow to $332,150, resulting in a total portfolio value of $469,550 and an annual dividend income of about $6,573. Now my favorite, the 30-year milestone. This is when the result sometimes looks unreal, but numbers don't lie. So, at the 30-year mark, his initial $10,000 would yield $509,500, and his continuous dedicated contribution of $10 per day would have grown to $1,302,320, resulting in a total portfolio value of $1,811,820 and an annual dividend income of approximately $25,365. Saving one of the most interesting funds for last, meet VLU, the SPDR S&P 1500 Value Tilt ETF, and this one has a strategy that genuinely sets it apart from everything else on this list. VLU tracks the S&P 1500 Low Valuation Tilt Index, which takes a uniquely intelligent approach to value investing. Rather than simply screening for value stocks and ignoring everything else, this index sorts the entire S&P 1500 universe into 20 buckets based on valuation metrics like price to book, price to earnings, price to cash flow, price to sales, and dividends paid. The cheapest bucket gets the highest portfolio weighting, and the most expensive gets the least, creating a natural, systematic tilt toward value without completely abandoning quality growth names. The fund rebalances and reconstitutes each April annually to stay sharp. In practice, this means a remarkably diverse portfolio of 1,444 holdings spanning large, mid, and small-cap stocks, something most value funds simply don't offer. Top holdings include Amazon, ExxonMobil, Google, Walmart, and Verizon, with sector exposure across financials, technology, healthcare, industrials, and consumer discretionary. Yes, you'll spot some familiar growth names in there, but they're deliberately underweighted and well-balanced against strong value holdings throughout the portfolio. That balance is actually a strategic advantage. If the market rotates back toward growth, VLU is already positioned to capture some of that upside in a way that pure value funds simply cannot. The expense ratio is just 0.15%, costing $15 per $10,000 invested, and the dividend yield of 1.7% is paid quarterly. But the performance is where VLU truly shines. 5-year annualized returns of 13.5% and 10-year annualized returns of nearly 14.5%, making it both the most diversified and one of the strongest performers on this entire list. Now, let's dive into the projection of VLU. The projection will still be based on Bobby's initial investment of $10,000 and his continuous contribution of $10 per day, totaling $3,650 per year. Using the historical blended annual return of 14.5% and a dividend yield of 1.7%. At the 10-year mark, Bobby's initial $10,000 grows to $38,800, while his daily contributions compound to $72,489, bringing the total portfolio value to $111,289, which generates approximately $1,892 per year in dividend income. Again, this may not sound life-changing yet, but that's because compounding only shines with time on its side. So, you've got to see the next milestone. At the 20-year mark, Bobby's initial $10,000 would yield $150,500, while his daily contributions would grow to $353,685, resulting in a total portfolio value of $504,185 and annual dividend income of about $8,571. Now my favorite, the 30-year milestone. At the 30-year mark, his initial $10,000 would yield $586,000, and his continuous dedicated contribution of $10 per day would have grown to $1,450,780, resulting in a total portfolio value of a whopping $2,036,780 and an annual dividend income of approximately $34,625. What this ultimately demonstrates is that ETF investing isn't about chasing quick wins. It's about owning the future and letting time do the heavy lifting. Stay consistent, stay patient, and let compounding work in your favor. The longer you stay invested, the more unstoppable your wealth becomes. Time in the market isn't just important, it's everything. Now, if you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.